Inflation just hit its highest level on record by one measure. This affects you. Let's break it down. Hi, I'm Keith Weinhold. This is Get Rich Education. 2 days ago, I went to the car wash, the same car wash that I always get. They just increased their price from $16 up to $18. And no, this is not the official inflation measure I'm citing that just hit a new record. There is no Weinhold Car Wash Price Index. We talk about more than just light dinner table topics around here. So we're going to get into some of the real inflation numbers, how you can profit, and then we're going to tie it into real estate by the end of it. But let's dig into these numbers. The core PCE was recently reported. Year over year, this inflation measure is up the most since 1992. Yeah, almost 3 decades since inflation has been this high by this measure. In fact, the first President Bush was presiding the last time the core PCE was this high. It rose 3.4%, and importantly, the core PCE, that is the measure that the Federal Open Market Committee tracks most closely. They're the ones that set interest rate policy for the nation. CNBC was just reporting on that, as you can see here. And this core PCE, Personal Consumption Expenditures Index, that excludes food and energy. If you include the food and energy, then the PCE itself was 3.9%. And the Fed has stated many times that they seek a 2% inflation target. So it's running substantially higher than that. And you know, it's very interesting. With these government inflation measures, the CPI and the core PCE, they strip out food and energy because they say those components are too volatile. Think about how crazy this is. We want to track these indices to measure changes, but the things that change the most are the things that they typically exclude: food and energy. And who can't live without food and energy? So I find it kind of laughable. So whenever you look at a core statistic, core in an inflation statistic typically means it excludes food and energy. You got to keep that in mind. Now, of course, the big buzz in the entire finance world has been, are these high inflation measures, are they transitory? That really just means temporary. Are they really going to abate, and are they going to wane? And really the answer is, I don't know. No one really knows the answer, but you need to consider, with all the supply chain disruptions we've had, just what that's done to inflation. Think about the United States and other places paying people to stay at home and some of the problems that's created in society. So when people get paid to stay at home, in fact, saving rates of Americans have been elevated because they're getting this money to stay at home. So you have a greater supply of dollars in consumers' hands, but you have a lesser supply of goods and services because those people staying at home aren't there to provide and produce the goods and services. So what happens when you have a high supply of money chasing few goods and services, and you understand exactly why inflation has been elevated? Whether the effects are temporary or not, I think an important thing to keep in mind is that once inflation elevates at, say, 4 or 5%, the CPI came in at 5% a few weeks ago, so these numbers really are occurring. But once that number gets elevated at 5%, even if it slows down to 2 or 3 after that, well, the prices are still elevated at that level. It's not like they dip down again. And a lot of people don't talk about that, so prices have already plateaued. No one expects deflation anytime soon. Put a YouTube like on this video if you would. I think that kind of helps me out a little bit because that tells YouTube it's a good video, but it actually helps you out too because it does make it more likely that if you put a YouTube like on this, that material like this will continue to show up in your feed. It doesn't mean that you like inflation. Now, I've been talking not too long ago about how 2 restaurants that I often go to, Subway and Qdoba, which is a fast casual takeout Mexican restaurant, they recently introduced a new question at the payment terminal when you go pay. They ask if I want to add a tip. Even if the prices on the overhead menu board stay the same, now you're being asked to leave a tip. 0%, 5%, 10%, 15%, or 20%. That's service inflation. I'm not getting any better burrito for that. I'm not getting any more service. I'm not having a waiter that's coming around. I'm being asked that question now, and I hadn't been previously. You know what I predict is going to happen next? Put in the comments below if this has happened to you, by the way. When you check out at the grocery store, If you have a human cashier, have you been asked for a tip there at the grocery store checkout counter with the cashier? I have not yet. That has not happened to me. But I was just shopping at Safeway yesterday, and I saw a higher ratio of these automated checkout kiosks to the human cashiers than I have before. And you know what's interesting? As people get more and more used to going to these automated kiosks to scan their own groceries, pretty soon to have a human cashier is going to be seen as some sort of upgraded service, almost like a little luxury. So therefore, I think that's why it is conceivable that in the near future, you're going to be asked to leave a tip there. So it's just another example of service inflation, something that 10 years ago, or not even that long ago, you sort of got used to having a human check out your groceries. That's now going to be seen as some sort of premium service. You're going to be asked to leave a tip for it. Just watch. And it's sort of an irony there. Understand that technologies are generally deflationary, like a self-checkout kiosk. That's normally deflationary because an employer does not have to pay a wage to an employee then, and that means less money needs to flow in the economy, and that suppresses wages for people like cashiers because their job just isn't as useful anymore. But in this case, if you're asked to leave a tip, that can become inflationary again. But understand that technology is deflationary. And it's not necessarily a faster processor in your iPhone 14. It doesn't always have to be high technology. Even the introduction of a wheelbarrow in civilization, a wheelbarrow is deflationary. Previously, maybe you could only carry 2 sticks of wood. Now with a wheelbarrow, you can push 12 sticks of wood. You can get more work done for the same price. Technology is deflationary, but the Federal Reserve and the Treasury, they can print endless dollars to create more inflation to fight this deflation induced by technology. But getting back to these figures, we've been talking about consumer prices, but what about producer prices? That's expressed with the PPI, the Producer Price Index that the government reports on. And it's really important to know the PPI because then you might be able to see what's coming down the road with consumer prices if you know what producer prices are first. And this is a headline I was talking about. The Producer Price Index just checked in at 6.6%, the highest inflation rate on record. Now, they've only been keeping this record since 2010, but that is a pretty substantial rate. So the PPI, the Producer Price Index, is basically how much it costs producers to make stuff. That's why it can be a harbinger of and a precursor to what's going to happen down the road with consumer prices. It's costing producers more to make stuff. Powell and the Fed want to keep inflation at about 2%. So we are seeing substantial inflation in real estate. It's not just the astounding fact that the median home price has now risen 23% year over year to a fresh all-time high of more than $350,000. It's never been there before. But let's look at some of the component prices that go into properties today that's causing this dramatic rise in home prices. Now, if we look at this from John Burns, I got access to his public earnings transcripts. Look at Whirlpool Corporation. Most people know that they make appliances. A Whirlpool spokesperson said exactly, quote, "We are facing rapidly rising inflationary pressures in Q1, primarily in steel and resins, and expect costs to continue increasing in Q2 and peak in Q3. We're just into Q3 now. Sherwin-Williams, the paint company, a spokesperson said raw materials were up mid-single digits year over year in Q1 and expect raw material inflation to be in the high single-digit to low double-digit range for 2021 with the highest inflation in Q2. Masco, they make plumbing products. They said expect raw material and freight costs to be up mid-single digits for the full year with inflation likely reaching high single-digit levels in Q3 and Q4. That might be something like 8%. Armstrong, they make flooring. They said they will continue to experience headwinds from higher raw material and shipping costs and expect costs to increase each quarter in 2021. And then finally, Caesarstone, they make countertops. They said while we did not experience a material impact from inflation in the first quarter of 2021, we anticipate higher raw material and shipping costs to be a significant headwind to our margins for the remainder of this year. So really, what's the takeaway here? Now that you got an update on inflation and what some of these metrics mean, I think it really harkens back to Buckminster Fuller. Buckminster Fuller was a substantial influencer in the Rich Dad world. I was a writer for the Rich Dad Advisors myself for 2 years. Buckminster Fuller said, "Don't fight forces, use them." If we're going to continue to have inflation led by the Fed and the Treasury pumping more and more money into the economy, rather than it impoverishing us, we can actually profit from it. If you watch my Inflation Triple Crown video series, you might remember a quick review here. What are the 3 inflation triple crowns each one? One is price inflation. You actually benefit from it when you get leverage as a real estate investor. The second way is through debt debasement. When you get a loan for property, you get to pay back the bank in debased dollars while the tenant pays the interest. And then the third in the Inflation Triple Crown is cash flow enhancement, where the cash flow, your passive income, outpaces inflation over time because your biggest expense is that fixed mortgage principal and interest. So you benefit from the Inflation Triple Crown when you do exactly this. When you buy a cash flowing property, meaning the monthly income exceed all the monthly expenses, and you buy it with a loan. Typically an 80% fixed rate loan is what you want. That's how you win the Inflation Triple Crown and turn this around. You've got to remember that inflation transfers wealth from savers and lenders to borrowers. That's why you want to be a borrower rather than a saver or a lender, as counterintuitive as that might sound. Well, hey, there are a lot of finance newsletters out there. Some of them cost hundreds of dollars per year, even thousands of dollars per year for some newsletters. And actually, that might be worth it. If you get one good idea from a $1,000 a year newsletter that makes you $10,000, well, then you got a 10x return on that newsletter. I want to invite you to check out our newsletter. And you know what? It is 100% free right now at getricheducation.com/letter. Here's a look at one of our recent letters. It's called the Don't Quit Your Daydream letter. And just like my podcast and videos, I really try to make things clear for you. So I tell you what these investing concepts are, why it matters to you, and then what you can actually do about it. You've got to make this knowledge actionable. So I wanted to give you an invitation here, now that you've probably been watching my videos for a few months. This newsletter, it gets into the mindset at times, and it really, I would say, it wires your mind for wealth. It helps you make money in your sleep, passive income, like almost only real estate investors can. And then it updates you on some important real estate investing trends. And it really teaches you then, rather than living below your means, you can expand your means. And you're really in the inner circle when you get our Don't Quit Your Daydream letter. In fact, the last 2 hires that I made here at Get Rich Education, we put the job announcement in the newsletter. So yeah, you could come work with me. The next time we have a job opening, I'll announce it in our letter as well. That link, getricheducation.com/letter, is below. I love talking about inflation and finance. It really fires me up. Thanks for being here. You weren't here for me. You were here for you. I'll see you in the next video.